Back in December, it was actually, especially in retrospect, a pretty easy call that the market was being overly pessimistic about the outlook for growth and the outlook for a lot of the risks on the table. Now, maybe they've moved a little bit far. We actually see the risks as more roughly balanced. That's why we've taken our equity exposure closer to a neutral versus our benchmark in a diversified portfolio. But you have to be looking at what is priced in. And if you look at what stocks have been most tied to Chinese growth and Chinese revenue streams, those stocks have moved markedly higher over the past couple of weeks. So we do think that some of that good news was getting more and more priced in, and the risks are probably more balanced as reflected in the market right now.
That's a natural course of things, though. The slowing growth in Europe is nothing new. We heard Draghi come out last week and talk about, I'm ready to go again. And
it's the degree to which
absolutely, it's that qualifier.
And what is priced in and what isn't, to Meghan's point.
But I believe that those issues would have passed in terms of not hitting the market if the market were lower.
Let me ask you this.
So those issues just become more important.
Do you think stocks are justified to be where they are today relative to where earnings expectations going forward are?
That's a great question, and that's why I've taken down some of the exposure. My answer is no. Okay, because I never believe it's a single point in time that you could focus on. It's the direction the market discounts.
It depends on your time horizon, too. So first quarter earnings are probably going to be a little bit ugly, but that might be the trough. And if you're willing to look out over the next few quarters to the end of 2019, the picture should get better.
Yeah, we've lowered the expectation. I think that's very obvious. Listen, I think the
same question that I asked Steve.
Yeah, I do think the market where it is currently is fairly valued. And I think it's
those stocks deserve to be here relative to where
I think certain sectors. I mean, Steve mentioned before two stocks. He mentioned Nvidia and Apple. I'm going to agree with him on in Nvidia. I totally agree with that. On Apple, I think what you're seeing right now going on with Apple is you had sentiment that became so depressed, and on the mutual fund side, you saw an absolute collapse in ownership. You're now beginning to see once again portfolio managers go back into Apple. Historically, that takes several weeks. So I could clearly see Apple taking out that 175, going to 180 on nothing more than sentiment. Sentiment alone.
If the S&P has a steeper decline, a more meaningful pullback, Apple, you think Apple's going to hold up in the face
I think
of that?
Relative to the S&P, yes, I think Apple will outperform.
But I think your point about the S&P is right, that it could pull back, but there's a lot of stocks that have already pulled back, perhaps in anticipation of these first quarter numbers. The point I'm driving at, there are stocks that are in the buy zone right now. They may not be your cup of tea. You know, Caterpillar right now trading at 10 times earnings. Something like an Intel, which is regaining its footing. Look at some of the financials. I mean, remember, it was about 2-3 weeks ago the financials took off. You had Goldman Sachs up, I forget what it was, 8% in a day. That's off 5%. The point being is that as much as the S&P is wobbling a little bit here, there are other stocks across many sectors that have come in and are giving you an opportunity to buy them right now. I'm not suggesting put all your cash.
Yeah, but there are many more. Look, the stat I went back a couple of days in my notes to bring up again. Two days ago, we brought up from Bespoke the percentage, of S&P overbought stocks topped 50%. For the first time since January. So there were, and then we showed the gains yesterday across some of the chip stocks and otherwise that are like 30, 40, and even bigger percentage points. There are many more stocks that have run a lot farther than those that have fallen into what you call the buy zone recently.
Yeah. But there's still a sizable portion out there.
And we know the stock market doesn't move in a straight line. It undershot in December. It's maybe overshooting a little bit on overbought conditions. But I think your question, Scott, about the level of growth and decelerating growth, what that means for stocks is really important. Because I actually, we think that slower growth, but still solid growth in the U.S. could be the best environment for equities. A 2% growth rate, that's kind of right in the middle there. It keeps the Fed a little bit more at bay. The risk is that what we're seeing in Europe and China, it's just not getting better. Okay. And the longer that stays negative, the more it'll be an overhang.